Again, Nicole Christensen from Care Answered, and I'm here with Mark Badami from the Center for Wealth Preservation. He is a financial advisor, and he specializes in long-term care as well. And he's going to talk to us about when to get on long-term care insurance, if it's a good idea for you, what questions to ask. And I'm going to actually start from the end, right? Because I'm going to talk about when to submit claims, what it is, how you can get your benefit the right way. So without further ado, let me start. So what is long-term care? So long-term care insurance covers costs related to in-home aids, assisted living facilities, and nursing home care, which aren't covered by Medicare. So the key phrase in long-term care insurance is long-term. So, for example, if somebody breaks their or hurts their knee, needs a knee replacement, and they have a surgery for that, the assumption is that they are going to receive rehabilitation care, either at home or in a facility, and get back to their baseline or better, meaning get back to ambulating and walking around the way that they used to. So that wouldn't be a long-term care reason to utilize the long-term care insurance. But think of anything that's going to be 90 days or more that one would need help. So I'm going to start the conversation about that with the cost of long-term care. According to the U.S. Department of Health and Human Services, nearly 70% of Americans who reach 65 will use some form of long-term care services. And that can have kind of many forms, and I'll talk about that in a moment as well. So the median cost, apparently in 2019, for home care aids was $52,624. And it is likely that cost in 2044 to turn into $110,183. Assisted living, again, the median in the US, which those of us that live in New York, it's higher, unfortunately, for both 2019 and presumably 2044. So for those in assisted living, it's about 48,600. In 2044, about 101,000. In nursing home for a semi-private room, in 2019 was about 90,100. In 2044, it could be 188,000. So we see how much it can increase for those that will be of the age to receive those benefits. But there are different ways to pay for long-term care. And some of you who may have joined my last webinar 2 weeks ago, I was speaking about New York State Community Medicaid. So that could be a way that you could also pay for long-term care. The reality is that that changes. So we don't know what will exist or how it will exist in 2044 or even in a year from now. For a really quick update on New York State Medicaid, for community Medicaid, in our last conversation, our last webinar, I was talking about a look-back period. And for community Medicaid, which is receiving that long-term care in your home or where you reside, the look-back period is going to change from no look-back period to 2.5 years of look-back. That was slated to start October 1st of this year, and then January 1st of 2021. And now it looks like that look back period will start actually April 1st of 2021. But I will update you with that on blogs and that kind of thing. And currently for nursing home Medicaid, there's a 5-year look back, and that's been the case for quite some time. So that means any transfers of monies that are made, they're going to look at that and penalize you, meaning the state is not going to pay for care for that amount of money that you utilized. So I don't want to get into the details of it, but it's an ever-changing thing as far as Medicaid is concerned, and that covering our long-term care. So what I want to say, and I hope that you all take away from my portion of this, is know your policy. Within Care Answered, we help a lot of people access their benefits, their long-term care benefits, when it's appropriate. We look through their policy, and so many times people don't have their policy because they purchased it many years ago, most of the time, and they don't have it. They don't know what it says. So if you have a long-term care policy, or someone you love or care about does, please advise them to request a copy of it if they don't have it themselves, and really read through it. You should know, of course, before you buy a policy, which Mark will talk to us a little bit about, but it's very, very important to truly know your policy. There are different things that are in play with every policy. Every policy can be very different or somewhat different. So you really need to look it over. And it also, those differences actually determine the eligibility of your reimbursement. So it's very, very important to look through. Also, some of the Care Answered clients themselves or their family members don't even know that they have a long-term care policy. Again, it was bought a long time ago. They didn't have that discussion with their children because they were children at the time, and it just never came up. So I've had clients in which we were looking through their records and say, well, what was this monthly expense? And found out they had a long-term care policy, which is very, very helpful. So really just review those, look over your policy. One of the things as far as determining your claim and getting the reimbursement that you need is often tied to ADLs, activities of daily living. Okay, so what those are traditionally are bathing, dressing, eating, toileting, transferring. So those are the things that you generally need help with to be able to receive the benefit from your long-term care plan. Now, oftentimes it's 2 or 3 of those ADLs that you need assistance with to be able to really get your benefit. But there are exceptions to that. Often a policy will say 2 or 3, but the exceptions might be if somebody has a diagnosis of dementia. Sometimes that eliminates that. I've seen when folks are receiving hospice services or eligible for hospice services, that can also remove the 2 or 3 ADLs that you must have. It can also, again, look at your policy, determine if sometimes there's a 90-day, 30-day, 60-day period in which you must be receiving services before you actually start getting reimbursed. But again, if there is some kind of diagnosis or specific circumstance, it could be that that you don't have to use that time. It could automatically, you could submit the claim and start getting reimbursed almost immediately. Again, every policy is different, so it's really important. Another one that I've seen is a certain amount of days in the hospital before needing it. So that's huge too. You want to make sure you know your policy. Okay, so the other thing that is really important in all of our work within advocacy is knowing one's diagnosis. There are many reasons why people do not find out their diagnosis. Some people don't want to know for whatever reason. They're nervous, they're scared. Some people don't have a primary care physician in which they go to regularly, so that they never thought about knowing a diagnosis, try to relieve themselves of any kind of appointments like that. But the reality is, for all of us, we have to know what we're working with. If you don't know a diagnosis and then potentially seek out a second and third opinion, then you don't know what treatments there are particularly for that diagnosis. You may not know the next steps to be prepared for what happens next with that diagnosis. There's so many things. So please see your primary care physician, but in general, especially before a long-term care claim submission, know your diagnosis so you know what's ahead of you and what your true options are. Okay, and a primary diagnosis can be huge and could stand in the way of getting your benefit. And I say that because I had a particular client who, fortunately, the family came to Care Answered early on, and she, in her policy, it said that if a primary diagnosis was one of mental health, that they would not pay. So if you don't know this, and you haven't even potentially gone to doctors and specialists that can recognize what your diagnosis should be, then you could lose out on a benefit that you've been paying in for years. In this particular case, our client had a diagnosis of anxiety, but after helping her and advocating and getting her to particular specialists, unfortunately, the reality is that she had dementia. And so that anxiety was a symptom of the dementia. So when we submitted the claim and the doctor selected dementia, having all of the evidence to say so, that made a huge difference in her life. Now she can get the care that she needs because her long-term care policy is activated and she has those funds now. So that is also very, very important. So when to submit claims? Sooner rather than later. There are so many people that submit claims so late that they get to utilize their benefit for a very short time. They were waiting for the big thing to happen, and that big thing already did happen, and they needed the help, and they bought that insurance to help them and kind of got it too late or didn't get to use it at all. So obviously different policies have different plans. So it could be only for 3 years that you're going to get the benefit. So some people are thinking, well, I only have 3 years of this benefit, so I want to try to make my money work for me until I really, really need it. And that's understandable and true. But again, it goes back to knowing your policy. You need to know what you need to use and how you can use it. So at least if you're making that choice, it's an informed choice, and so that you can really access your care. So if you find somebody that is in need of trying to figure out what their policy says and how it affects them, you can certainly contact us at Care Answered. We'd be happy to review the policy and assist you. How they determine and assess your eligibility of utilizing the benefit is different. Sometimes, well, pre-COVID, right, they would send out a nurse assessor. Care Answered would be there at those assessments to make sure all the information and gather all the information from your different doctors to make sure they're getting all the correct information. Sometimes it's sent directly from clinician's office. So again, working with the clinicians and their patients, of course, to make sure that all the information is there, because many people have different doctors for every part of their body, and it makes sense for all of us to make sure that they're all talking to each other and that coordination is there, And particularly for your claim submission, you want to make sure that the details are there so that you can get the benefit that you've paid into. So I think that about covers it. Does anybody have any questions about what we've talked about so far? Check the chat. Oh, I don't see any questions. If you have any questions, you can certainly take yourself off mute and ask them. All right. So if not, I'm going to move on to the next part of our webinar, which is with Mark Badami. Mark and I have worked together before on issues like this with clients that we shared, trying to get all the benefits they need from their long-term care insurance. And I know he is great at what he does. And so I'm really, really excited and happy to have him here to talk to you more about long-term care insurance. Mark?
Thank you so much, Nicole. Thank you for the plug too. Listen, for people on the line, I have to tell you, I've been in the financial services businesses for about 26 years. And when I first met Nicole, I thought that was very interesting that what her job, her role was, and what her capabilities were. And I just kind of put that in the back of my brain housing group. I didn't really think much of it, but I was like, I was kind of young in the insurance business, I guess, and didn't really have a particular need until it arises. And then you're like, your client calls you and says, how do I access the benefits to my long-term care policy that I bought? Or how do I find out what services I can get from whatever industries or whatever agencies are out there? What can I do for my parent, my loved one, my sibling, my child, whatever? And you don't know where to go because you have to really put a lot of time and a lot of legwork into doing the research, and you have to eventually become an expert just to help that one client. And I found that with Nicole, that was an instant need for Nicole's services. And she was able to simplify the process, get the client paid on claims, fight with the insurance companies to make sure that the client was getting everything they needed. And then she was also able to get other services that the state provided that the client had no clue that the state had those things available. So this is like why someone like a Nicole in this realm, in this space, fits in perfectly for just about everything that you have to do with the long-term care aspects. And it's very, very complicated scenario. I wouldn't expect any of you to try and, or to want you to try and become an expert in an area, because what's going to happen is you're going to have to become an expert in it if a need arises, and it's time consuming, and it does affect your life. So having someone like Nicole, and it's perfect. So thank you, Nicole, for doing your services to everybody. And it's funny because when I talk about long-term care, I get a lot of, I agree. Like I get a lot of head shaking. Yeah, I need that. Yeah, that's very important. Yeah. But no one runs to buy the product. When I talk about long-term care insurance, it's one of those things that they see the need. They think it's fairly important, but it's not going to happen to me. So therefore I don't need that. So somebody else might, my next door neighbor may, but I'm not going to need that. And I couldn't understand why I had that disconnect that happens with, yes, I see the need, but no, I don't need it. And I didn't understand it until I came across a term, and it was called cognitive dissonance. And it's the psychology or discomfort created when a person believes or undermines the facts to the contrary. They ignore the subject and they don't believe that it's going to happen to them. Or they rationalize the behavior that they say no for a reason that's unbeknownst to us. And they can't quite see the need to change their behavior to understand why they need this service or why they need this product or why they may need help. I have too much money. I can burn my money and still have enough money to leave to my family. Oh, that might be true. That could be true. I don't know. Or, the state will take care of me. Okay, that could be true too. I mean, That is a possibility. Those are two real distinct possibilities that could happen. But there is also that possibility that the family doesn't want to impoverish themselves and they want to help to take care of that loved one. And that's a need to take care of that person. It may happen to anyone at any time, and it could be you, it could be your spouse, it could be a partner, it could be a parent or even a sibling. And the need for long-term care may result from being chronically ill. It could be a severe cognitive impairment or something unexpected like an accident. God forbid you had an accident. But what's for a fact, it's definitely 100% a life-changing event that would have devastating consequences on you, your spouse, your children, and your ability to keep financial promises during retirement. And one of the questions that arise is, well, what do I see that it's important for me? So who will take care of me if I were to need care? Will I be able to stay in my home? That's a common question I hear all the time. And how will I pay for the care? Designing the correct policy, if you decide to go that route, to buy a policy and cover that, is critical. And it takes time. And you have to understand what your needs, goals, wants, and desires are. And you can always design a policy to fit your need, or to fit your cost level. And that's what people like to do. It's like, well, how do I fit that? So where does the client, you have to understand, where does the client want to live? You have to figure out, where you want to have the care provided, and who's going to pay for the care. So with that, let's talk about the different types of policies. So there's a traditional long-term care policy. It's like a standalone plan. And with that, it usually it's usually the more expensive of the long-term care elements, but you can design around that. And depending on, for argument's sake, long-term care, the cost for care is relatively inexpensive for what you get. It's the riders you put on it or how you build a policy that becomes more expensive. So understanding where you're going to get the care and how you're going to get the care and when you want to start receiving the care is critical to determining what the cost of the premium might be for the insurance, if you were to choose that option. So you can get an individual policy, you can get a traditional policy, you can get an individual policy with a spousal or partner discount. You can get 2 individual plans with shared care benefits where you can cannibalize the other person's benefit if they're not using it and use it for your care. You can get a life insurance policy with a long-term care rider. You can get a life insurance policy with a long-term care, a linked life insurance policy combo benefit. So it's mostly a long-term care benefit, but it has a death benefit to it. You can get a life insurance with an accelerated death benefit option, so you can access the death benefit for care should death be imminent, and that's one of the ways that you can get out of it. Or you can buy an annuity with a LTC rider on it, and that can be helpful also. So depending on what you're willing to spend or what you're willing to cover is going to determine which is the best option for you. I can tell you that there is no right answer, but if you wanted to just self-insure, that's always an option, and people are okay with that. Self-insuring is an option. They just have to understand what the pros and cons are of doing that. So when designing a plan, the first thing you want to take a look at is, well, when do you want the plan? What's more important? Is it a benefit period that's more important, or is it when you start receiving the care more important? Can you design a plan that's going to have you satisfy your blackout period or elimination period, the time before the benefit starts kicking in, while you're at home receiving care, or do you have to have a 0-day elimination period where it just happens instantaneously, or can you wait? Can you afford to wait 90 days, 180 days, a year? Can you afford to wait that long and pay out of pocket for that care to happen before you start getting the benefits paid for from the insurance policy? All those are factors in determining how much the cost of care is going to cost you for protection, for the protection part. Inflation protection, it's a very expensive rider. How do you want it, do you want to buy a policy that has a $300 a day benefit and no inflation protection, or you want to buy a policy that has a $300 a day a $300 a day benefit period and a 5% compound or simple interest inflation rider. These are things that you have to determine, and will add to or subtract the cost of the product. Then you have to decide how you want to get the payments. Do you want to get reimbursed for it? Those are usually the ones that have the most cost-effective ways of getting paid. You spend $1,000, you submit those claims for $1,000, and you get paid back $1,000. You spend $2,000 the next month. You submit those claims for $2,000, and you get back $2,000. Now, with reimbursement, though, you have to understand, if when you put those, fill in the sheet, there's something that's not necessarily covered, you may not get full reimbursement. So you may say like, well, John Smith is receiving care. John Smith's attendant that comes to the house to take care of John Smith takes care of him, does all the stuff that he's supposed to do. And the person maybe cooks for him, maybe cleans him up a little bit, gives him a shave, whatever it may be. And just before John dismisses the attendant that's taking care of him, he says, "Can you just cut my hair for me? Just clean it up a little bit, because I've seen it's getting a little long." She says, "Sure." She cuts his hair. She puts down on the thing. It's $25, whatever it is, and whatever. You submit the claims. You see all the stuff that the prudent person would look at to see if that's taking care of John Smith at home, and then a haircut. Well, guess what? The haircut is not covered because the haircut is not part of that care. So not knowing that wasn't covered, that's an expense that now John has to pay, or John's estate, or someone has to pay. In order for that attendant to come back, they have to get paid. So these are things that you have to understand. That's what Nicole helps with, is she helps you determine what those things that are being taken care of, your spouse, your friend, your whatever it may be, whoever's being taken care of, those are things that she has to fill out to make sure that those things are covered. If it's not covered, then you're going to be unhappy. You're going to be like, well, this insurance policy sucks. I don't really get paid on anything I put claims in for. Well, maybe you're putting them in the claims wrong. Maybe you just don't understand how to do that. Maybe you should hire a professional to do that for you. And that's what's important, to have the synergy that Nicole does with the people that your loved ones who need the care. So when designing a plan, company matters. Believe it or not, company matters. It's not a price thing. It's not like, well, it's going to be the cheapest price. If somebody wants something really badly, they'll pay anything for it. But if someone needs something, they want the cheapest product out there because they just need it. And I'm being forced to buy it because my family says I have to buy it. So just give me the cheapest thing out there. I'm never going to use it. Just give me the cheapest thing out there. Well, that came back to bite us in the ass because everyone's buying cheap back 10 years ago. And all of a sudden, insurance companies realized that, hey, you know what? We priced these things wrong. So guess what? We're going to raise the premiums. I saw premiums being raised, that people were paying their premiums for 10 years, and all of a sudden the premiums got raised 60%. 60%. That's a real number. So if you're retired and you're living on a fixed budget and you're already assuming that how much you're paying for your long-term care insurance, you're paying that every single month, and all of a sudden you got a 60% increase, that stings. That can really take a bite out of you, and that's going to affect whether or not you're going to keep the coverage or have to make a change to it in order to keep that coverage. Because truth is, you can't go out and find another product out there because you're older. Let's say this person was 10 years older now, and their health may have changed. A lot of things happen with change. I heard a funny statement the other day. He said, "I am enamored by the fact that a sneeze could knock my back out of whack." How funny is that? As you get older, little things that you take for granted all of a sudden start affecting your lifestyle. A sneeze could actually put you required to take a claim for this long-term care policy because you might be out of whack for the rest of your life. Who knows? It depends how bad the sneeze is, I guess. He also said something funny that was like, I'm also tired of peeing in Morse code at night, but that's besides the point. So anyway, this is some of the things that we have to look at when we look at policies. We want to know if we want to get reimbursement. We want to know if we want to get partial cash reimbursement, or you want to get paid for home care only, or you want to get paid for only facilitative care. A lot of my clients typically don't want to go to a facility. They want to stay home to get care. So you want a policy that covers you for that. Care actually used to be, 10 years ago, care for home care was a lot cheaper than it was for going to a facility. And now, unfortunately, you start seeing that the need for home care is starting to rise. You're starting to see a rise because now you have a lot more people that are kicking and screaming about going to facilitative care, and they're getting 24-hour care at home now. So it's nice that they're having it there, but it'll be a little bit more expensive, but you can actually get professionals take care of it 24/7 and not just two people living at your house, which is kind of cumbersome in itself. And, most people typically say, well, my spouse will take care of me. Well, I tell you, this is what happens typically, is taking care of a sick person or sick spouse makes the well spouse sick. And that's always the case, because they're going to want to take care of that person to the best of their ability, but something's going to happen. They're both going to get old together, and they're both going to be in a different state than they were 10 years before that, or 20 years before that. But there's going to be a point when that loved one cannot take care of that sick one, and it's going to be because they just got sick of it. And I'm not talking like just the mental part. It could be the physical too. They could just be too difficult to move. So with that being said, I was also the victim of selling cheap to my family. My mother, I sold her a policy that the company went out of business 20 years after that the company was in existence. It went out of business, and the state took it over, and now it's state run. The policy is still valid, but that's a big deal. Now the state took it over. You're dealing with the state agency to get reimbursed for it. And thank God she's still healthy and she's running around doing all the things that she normally does. But I'm dreading the Cole's day when she has to start taking over my mother's benefits and figuring out how to get them, because she's going to be fighting with a state agency instead of fighting with just an insurance company. So that being said, if anyone has any questions on how to build a policy, I can definitely talk to you offline, or if you want to just ask some questions out to you or to the group, I'd be more than happy to help you answer some questions.
Mark, that was excellent. Thank you so much. And I see we have a question right now. Can you speak a bit on the pros and cons, hopefully pros, of the New York State Partnership long-term care insurance policies?
Absolutely. So it's funny because I was going to bring that up too. Partnerships plans about 10, 15 years ago were very, very popular, mostly popular amongst teachers, because teachers felt like, well, this will protect my income. This will protect my assets. It's true. Partnership plans will protect your assets. It will. It doesn't protect income. So two teachers, they each get partnership plans. They're both living on their pensions. They're getting income coming into the house. Income is coming in from their pensions. They reach the age, in this case now, 72. They reach the age of 72. Does anyone know what happens at 72? Anyone? Bueller? Right. 72 is your required minimum distribution. Since the CARES Act is the required minimum, Secure Act, the Secure Act came in and then changed the required minimum distribution from 70 to 72, which is better because it takes you a little more time before you can defer taking minimum distributions out of your IRA. However, it doesn't do anything for a person who's on care, who's receiving care. So what it does is it says 100% of the income has to go towards your care. Anything after that, it's not covered. That still you still have a cost that's left for the care, is paid by the partnership plan. It's paid by the partnership plan. So it is protecting your assets. It's not protecting your income. Now, there's a couple things that happen there. One was 100% of the assets, income that comes into the house for that person, that individual who needs the care, has to be used to cover that person to cover the care. If you're two teachers, or anybody who has a pension, and two people are receiving pensions, and you're used to living on 100% of whatever you get from both of you, all of a sudden 50% of that income stops because it has to go towards the other one's care. So your lifestyle is definitely going to be impacted. So while it's protecting the assets behind you that you have a pool of assets, you may have to use them to supplement the well person's lifestyle, because now 50% of the income is not coming into the household. So partnership plans only starting to come out of favor when they started using the benefits. When people started realizing, oh, wait a second, this is not as good a deal as I thought it was. When it was so cheap when I bought it back just before I retired from the teachers union, and they were saying partnership, and everyone was going for them, and they were considerably cheaper. They were about a third less money than, or maybe 2/3 less money than an individual plan, but you get what you pay for. So if people's buying on cost, and that's what happens, a lot of people when you need something, they buy on cost, and they only buy the cheapest when they need something, and they say, well, take care of me, and we'll figure it out when it happens. Well, when it happens, it's, why did this person tell me this? How come I didn't know that? I didn't have any idea. So now all of a sudden, what's that called when you intentionally forget something, or forget something and you conveniently forgot that person explained that, but they still sold it to you anyway. Anyway, right. That always happens. So you want to kind of like understand how policy benefits are paid, what the pros and cons of each of them are, and design the plan around you, because it's very easy to design a plan that's going to fit your lifestyle. And if you wanted to make sure that at least, if I don't use the benefit, do I lose the money? Well, if you want to get reimbursement for that, you can put that as a rider on there. Or if you want to use a different type of product, like one of the hybrid products out there, using life insurance first and then the rider of the access and death benefit second, that's fine too. You still have access to your benefit if you need it when you're incapable or incompatible, or when you're disabled, I should say. But if you die and you never used it, the death benefit goes to your beneficiary. So you never lost a penny. That's another way too. So anyway, any other questions?
Yes, we have more questions. And I just wanted to go back to that with the partnership. So what I heard is it protects your assets, but it doesn't necessarily protect your income for those that have pensions, certainly. And what about, does it do anything else? Do their premiums go up just like everybody else? Is there any change in that, or no, for those in the partnership?
Yeah, listen, with long-term care, it's not life insurance, so it's governed differently. Long-term care is health insurance. Health insurance is mandated by the state. So if the insurance company feels like that they made a mistake in pricing, they can petition to the state with a whole block of insurance. They just can't raise one person's insurance premiums. They have to raise the whole entire block and say, look, this is why we made a mistake. This is how we made a mistake, and they have to verify it. Now, New York State, I'm assuming most of you are in New York State. New York State happens to be a very consumer-friendly state. They really are looking out for the consumer, and they're putting in legislation that makes it very difficult for insurance companies to do something like that, to raise the cost of premium to a higher amount to cover their costs, because they're like, well, New York State's kind of like, listen, that's what you designed originally. We're going to stick with it unless you can prove something better than what everyone else was doing. You're stuck with it. Figure it out. And that's the way they are. That's the way New York State handles it. If you bought your policy because of New York State, the premiums in New York State are much more than that of Pennsylvania, Connecticut, New Jersey. So some people looking at cost, sometimes there's, well, I actually have a vacation home in Pennsylvania. Why don't I just buy the policy in Pennsylvania? And they do, and that's where you run into problems. Because I live in New York State, I can use my benefit in New York State, but I bought the policy from Pennsylvania. So now if they wanted to raise the rates, Pennsylvania is a very lenient state. They'll say, well, if you prove it, we'll raise the rates. And that's what happened to my mother, whose policy was bought in Pennsylvania. So Pennsylvania took over that policy and now is in charge of that block of insurance business.
Oh, that's a good one. Okay. So the same, Pam said, after 10 years at the same premium, the partnership started raising premiums annually starting 2 years ago, just so everybody knows. There's another question about premiums. Are there guarantees in a policy where premiums do not change? And,
Yes.
okay.
So, okay, I'm sorry.
The
So,
three-part question. So that one's the first part.
okay, so the first part is yes, there are. That's why company is important. You have to know what companies treat their policyholders very fairly. Usually, mutual companies treat their policyholders very fairly. Stock company, they answer to a board of directors. The board of directors wants to see profitability. If they don't see profitability on blocks of insurance, they have the right to petition to the state to try and raise the rates. So usually mutual companies are much more policy owner friendly. As far as other guarantees, other than guarantees, than finding a good quality company that's a mutual company, there are. So I bought my personal long-term care. I bought what's called a 10 pay. I paid 10 equal payments over a 10-year period, and I was completely done. And once that last payment was made, they cannot go back to and renegotiate that block of business. That's locked in, set and solid. It's done. It's locked in. Life insurance that has a long-term care rider, they usually can't raise that. They may be able to raise the rider, which is the long-term care portion, but that's usually a very small amount of money compared to the life insurance premium. That's why people they don't usually run to life insurance as a first option, because you kind of have to have the affordability ability to it, because it's a little more expensive. It's a lot more expensive than buying a standalone policy, but it has a lot more guarantees attached to it, and you can buy a rider to help subsidize that. So that becomes a little more expensive. It depends on affordability types of issue. But for sure, if you bought like a fixed premium payment that was fixed for a certain amount of time and you lived out to that end of that term, yes, it's locked in. It cannot be changed.
Okay. What is the alternative to claiming reimbursement? Do you just receive the money each month? So there's different policies, as you were saying, to purchase regarding reimbursement versus being paid actual money.
Unfortunately, like today's policies are pretty much just reimbursement. The old days, you can have a cash benefit option, which they made a mistake on that one, but that one, that was as soon as you qualified for a benefit, you didn't have to submit a claim. You just got the cash direct deposited to you. And once a year, they would send out someone to just make sure you're actually still needing the care. Then you had a reimbursement, then you had an indemnity where you just had to qualify based upon one ADL, two ADLs, but one need for the payment to be made to you to get reimbursed for it. You get the full month, whatever your monthly benefit was. That's called an indemnity. And then unfortunately that kind of got taken away too, because just like anything else, if someone starts to abuse it, the insurance companies are slow, not stupid. They'll just take it away and won't offer it anymore. So now it's pretty much all reimbursement, and you have to verify, and you have to really cross every T and dot every I before you get reimbursed, because they are very much sticklers. They're worried about people taking advantage of them and trying to escape the system. And it used to be a very easy thing to get reimbursed. You used to be able to use your spouse. You can get paid your spouse, and now you have to have a paid healthcare professional to take care of you. So,
yeah, one of my clients had one of those fabulous Cadillac policies, as I say, that they just got money. So it was very, very beneficial that she had it. Next question is, how do we help seniors understand that the policy they bought 30 years ago was purchased to pay for care and not to be afraid to activate it? So many seniors fail to see this is the rainy day they planned for and wait until the last minute to use it. I think that
question, Patty? That's such a true statement.
Yes.
Nobody wants to admit defeat. Nobody does. And the guy could be sitting in his bed with his legs up in the air, stuck in freaking traction, and they'll be like, "No, I'm good. I'm going back from this one. I'm not going to put a claim in." I don't know what people wait for, but put the claim in. The worst thing they can say is no. That's the first thing. The second thing is, sometimes it's a legit reason, and the insurance company said, no, you want the clock started at the date of the original application that you stuck it in, so that if you still have to fight with the insurance company, they have to go retroactively back to what the date you still put that thing in, or when the accident happened. And if you didn't put the claim in for the initial accident or whatever happened, whatever that event was that caused you to trigger the benefits that they're not paying for, you ain't getting paid, which is kind of stupid. It's there. You have it, use it.
Yeah, it's again about really, I think, knowing your policy. So if they purchased it yesterday or they purchased it 30 years ago, it's a matter of going over the policy. I find that's been helpful with my clients to break down how much they've paid for this policy, and to say, okay, you've paid blah, blah, blah over the past 20 years, and it's tens and thousands of dollars. So let's use it. That's what you got it for. And that money's not going anywhere. For those that don't have a rider, it's not going anywhere. And most people don't like the idea of paying insurance companies. So sometimes that works. So basically I've said things like, did you want to pay ABC Insurance Company? Because that's what you're doing by not utilizing it. And the money sometimes, yes, I'm not beyond using a guilt trip, if it makes sense. But sometimes people really want to give money to their loved ones. And so by not utilizing that claim and their insurance, they're going to have less to give their loved ones because they're using it from their own assets or what have you, their own funds. So I try to make it clear that they don't want to pay the insurance company for nothing, as well as it gives their family peace of mind. That's the other thing. It gives one's family peace of mind that they have the care in place and that it's covered, because that's probably why they bought it in the first place. So going back to that idea, and again, as an advocate, I'm better able to do that, I think, than oftentimes than my clients' actual loved ones, because I'm not their child, so they can't say, why are you talking to me about this? So that's been what's been helpful when I've been talking to clients. But it is so true. It's a shame when people don't utilize it. It's really quite heartbreaking that they don't use it when they really needed it.
I just wanted to jump in and say, I think a lot of them are afraid. They think they're going to need it later on, and they really need it now. And they're afraid to use it because they think it's not going to be there for the future, not recognizing that they can have help now that will, give them the use of the policy rather than it going to waste, because I've seen so many people that have, passed before they've actually gotten the full benefit of using it.
Yeah, that's absolutely true. And the other thing that I mentioned, which I also think is true, is that, as Mark had spoken about, there's different policies. So if they actually know their policy and they say, that's only going to pay for 3 years. And I don't think, I've talked to my doctors and I've talked to my family, and I'm thinking I'm going to need that 3 years from now. That's an option that you're making with information, which is very different from, I think, what you're talking about, Patty. It's just not wanting to do it and not knowing if it's the right time and that kind of thing. So it's just really being informed about your policy and all of your options. It also goes back to the diagnoses. People are afraid to hear things, but that information is crucial to make the decisions. What we do as advocates and informing people so that they have to come up with their solution. But what they do need to know is what their true and real options are. But it's an ongoing difficulty, I know.
So just to add 2 things to that, Nicole, you're so right. So understanding the policy. So when I hear like someone say like, oh, I only have 3 years of benefit left. I only have 3 years of benefit. I don't want to use my benefit yet because I think I'm going to get worse.
Right.
Okay. This is something I learned. I was in the military, and I had desert warfare training. And the first thing they said is, you get lost in the desert, don't conserve your water. Drink your water as if you're going to get rescued tomorrow. don't conserve your water because they found military people that are dead with full canteens from thirst. You know what? Exercise. If you can exercise that benefit, you exercise it, because the best thing that's going to happen is you're going to, first of all, with reimbursement plans, just because you have a 3-year benefit, if you're not using the full daily benefit to take care of yourself, it's going to extend the plan longer. So it doesn't say 3 years, and if you don't use the money, that's all that's allotted to you, it's over. It's over in 3 years. If you have a $300 a day benefit and you're only using 150, it's going to extend the benefit to 6 years. So use the benefit. It's better than coming out of your pocket, because you're spending money on the premiums and not getting a waiver on that. You're still spending money on the premiums for those insurance premiums, and you're taking money out of your savings to pay for your care, to have someone come over there. So use all the benefits you can. If you use it up to very last drop and you're done, the policy is totally exhausted, and then you still have another 3 years left, well, guess what? You have to start using your savings then. But it's better than using your savings to start with. Use the other people's money. Use the insurance company's money. Don't do that. Don't not exercise the right because you say, oh, I think I'm going to get worse in 3 years. Well, you might. You surely might. But there are other options, and you have to think about it, think it through. Now think about that poor guy who died in the desert with the full canteens.
Yeah.
That's
a really good point, Mark. Thank you for sharing that. That's a really good point. It's kind of like put on your oxygen mask first. Okay. There's something about another question was, can you elaborate a bit on a hybrid policy?
Sure. So with the need and developing, with the aging of the population, people just can't buy a one-trick pony, which is a long-term care policy that will only take effect for one thing, and that's if I have a qualifying event that causes me to exercise that one policy, that one-trick pony. That's it. So people don't like that, and they wanted to have options. And their constant thing was, spend all this money, I may never use it. It's true, you may never use it. It's kind of like auto insurance. I may never get into an accident, but I have to buy the stupid thing because the state mandates me to buy it. When you finish paying off your mortgage, you don't have any restriction to that, and you still have your homeowner's insurance. That's an interesting thing. You still have your homeowner's insurance for a house that no one's mandating you to get homeowner's insurance, but you say, well, what if there's a fire and it burns down my house? Well, that's true. What if there's a fire and it burns down your house? What if there's a life-training event that causes you to need a long-term care policy to pay for your long-term care? Anyway, people started demanding a different type of coverage. So what they started doing is coming up with life insurance policies or annuities that had a hybrid feature, a feature of a long-term care, able to access the death benefit early or able to access the annuity benefits greater than what the annuity payouts would have been. And that's pretty much what a hybrid is. The hybrid is going to blend two benefits together and allow one, it's going to be a little bit better for the person who feels like they're never going to use it, because look, you're all going to die no matter what. Everyone's dying. We may never need care though. If we don't need care, I want the monies that I spent on insurance premiums to go to somebody, and the death benefit's the best thing. If I do need care though, I want my life estate, that whatever I left behind me, my estate, I want it to go to my loved ones also. But I didn't want to waste my money on spending on my care because I want to leave them something. So life insurance or annuity might be a good option, and that it covers also both bases. That's what a hybrid is.
That was great. Thank you so much. Thank you everybody for being here and listening. And I hope it was super helpful. We're going to end now. It's been an hour and it was delightful. Mark, that was really wonderful. Here you can see the contact information for Mark as well as myself. So you can ask more questions. And he has made himself available to speak with you. So thank you once again for being at this webinar, and stay tuned for next month's webinar. Have a great day, everybody. Thanks, Mark.